Hey there, good morning. Welcome to the Mortgage Rate Forecast with Scott Criss, your mortgage rates and news for April 19th. And so let's get started with the news. Bonds are currently trading at 101.90 this morning. Initial jobless claims came out and they were slightly helpful for bonds, but the Philadelphia Fed really kind of punched them in the chin. We are seeing stocks slightly down today, which can generally help bonds, but it's not. So it seems like right now traders are really focusing on the technicals. So to really get into the technicals, let's get over to the charts. Here's where we're at. If you look at my mouse right now, we are at 101.90, and you can see we opened, we had a little bit of good news, but then we're really testing that support level. This is really bad news for bonds, especially since April 9th, we've developed this downward trading channel. So we're really being cautious right now, guys. If we do break and close below this support line at 101.89, that could become our new support resistance level, kind of pushing us down. So to kind of quantify where bonds are at right now, Freddie Mac reported in March, average consumer got a 4.44 with half a point. Well, that's back when bonds were averaging about 102.50. If we're at 101.90, that's 60 cents worse. So the average consumer trying to get that same rate is likely going to be paying more than a point now. So that's where we're at. Let's get to the forecast and projections. My last projection was a hit. Bonds last Thursday came right in with my trading range, kind of on the lower end of it though. So as far as our outlook going over this next week, in the short term, analysts were pretty inconsistent. Some were bullish, some were bearish. They thought yesterday could have been the worst that we can see for a while, and that we developed a new floor. But some think that we're continued this downward trading channel. But the one thing I think they all agree on is the long term bonds are likely going to be continuing to pressure downward because, again, quantitative easing, not to beat a dead horse. So here's where we're at with the forecast. I believe we will not go above 102.37 or below 101.56. And if our current trading right now is 101.90, we have room to go down and get worse by, over 30 cents. We could be on the upside by over 40 cents, but I don't want to be chicken little saying the sky's falling here, but I do think the technicals are really going to be pushing bonds down over this next week. So if you're floating a loan or you have the ability to lock and haven't locked yet, I personally think it's a good idea to consider locking. Nobody has a crystal ball, but all the technicals are pointing toward more pressure on bonds, unfortunately, right now. So anyway, that's it for this week. We'll be back next Thursday. Leave your comments and questions down below. We'd love to hear from you guys. Don't forget to hit that like button before you go. And if you want to keep a pulse on everything that's going on with interest rates and how they're moving, hit that subscribe button. It's over at the top left, and you'll just get a little update when we release new content. And if none of this really made sense to you, like, hey, how do these charts and stuff really impact me as a consumer? I'm just trying to get the best rate. Mortgage Bonds 101, that's at your top right. Click that, and that'll teach you the basics you need to know when you're trying to figure out how to get the best mortgage rate. Anyway, that's it for this week. We'll see you next Thursday. Take care, guys. Bye-bye.